All right. Let's get started. Thanks everybody for joining in today. This is Option Trading for Beginners. This is for educational purposes only. This is not financial advice. Make sure everybody take notes. Got some good information for you guys. Hopefully help you get to your financial goals and maybe learn something new that you very well may not have known in the past or before today. So let's start it first off. How does the stock move? How do stock move? Stock move in increments of as little as 1 minute. The most common denomination is 15 minutes. And you can see right here on my chart, the most common denomination, the most popular time frame is 15 minutes. Every green candle indicates that the market is going up. Every red candle means that the market is going down. And each candle represents 15 minutes of the day on this particular example. And as you see the little line at the top and the ones at the bottom, these are called wicks. So what these wicks indicate is that the market opened up around this and it dropped down and end up closing at 15 minutes. Within 15 minutes, when it's high as here and when it's low as here, it ended up closing at 15 minutes right here where the solid part of the candle starts. And then as the next 15 minutes starts, right, it dropped down. It dropped down as low as this. It went up as high as this, and it ended up right here at the top of the red. So it ended up going lower than it actually opened on the last time. So every time, and now it opened higher. So you got a green candle. Then it opened lower at the next 15 minutes, higher, lower. And the market kind of does this throughout the day. It goes up and down. It's kind of like a heartbeat monitor. It just goes up and down. And that's basically how the market moves. And you can change your time. A lot of people, I use 15-minute increments because this is the most popular setting that traders use. 15 minutes is a good indication of where the market is going. Some people have theirs on a minute. Some people have theirs on 10 minutes. You can customize this, and we'll get a little bit deeper into that as we get into this course, as far as how you can change all this stuff, and that'll be a little further down the road. But just to kind of give you an idea of how the stocks move, they constantly are moving over this all throughout the day. Even now that the market is closed, the stocks are still moving. They're still moving up and down, okay? So this is an options trading course. And most people would be like, hey, Lamar, why wouldn't I just buy the stock? Why would I buy the options? So this is the definition of when you buy stock right here. Okay. When you buy stock, you buy shares or stocks. That's considered the same thing. And you own a percentage of the company. So if you look at a company is broken up like a pie chart, and each individual share represents a percentage of the company. The one who has the most shares, they pretty much own the company. A lot of times you got shareholders who have interest in the company. And as you buy stock, you're pretty much buying a part of the company. So when people say buy a stock, you're really investing in products that you probably already normally use. Okay. And when you buy stock, if the stock price goes up, you make money. The stock price goes down, you lose money. Right? That's just simple, cut and dry. Stock market goes up 10 cents, you just made 10 cents for every share that you own. Some stocks also you're able to earn dividends. Dividend is where they take the yearly profits and they divide it amongst all the shareholders, and they send you out a check, whether it be quarterly or annually. Some do it every 3 months, some do it once a year. And that's the benefit of getting stock. You can get it like Coca-Cola is one of them. They has a dividend. They give you a certain percentage of the profits earned within a quarter or within the entire year. And another thing about the stock, there is no expiration on the stock unless a company goes private, like what Twitter just did. When Elon Musk bought Twitter, they went private. They came off the Dow Jones and that. They came off the whole New York Stock Exchange. So some companies, and that's when you hear when companies go public, that means they're being traded on the public stock exchange, and now you're able to buy stock and invest into that company. Or if a company goes bankrupt, like the .com, Enron, all that stuff, those companies no longer exist and the stock is gone. But other than that, when you buy a stock, you own it forever. As long as that company is within existence, you own it forever. Okay. Now, when you're buying options, now there's a difference when you're buying options. It still involves stocks. It still involves the market. When you buy options, you purchase the rights to buy or sell shares at a specified price before a specified date. You never own the shares. So when you're buying the options, you're pretty much just renting. You're just leasing the shares for a period of time, and you can sell them at a specified price before a specified date. We'll get in a little bit of that later in this discussion. Each contract gives you the rights to 100 shares. Okay, so each option contract that you buy, it represents 100 shares, 100 individual shares of that potential stock, right? And when you buy options, depending on your position, you can make or lose money if the stock price goes up or down. So in a nutshell, when you buy options, you can make money when the stock goes up. You also can lose money when the stock goes up. And the complete opposite. You can make money when the stock goes down, and you also can lose money when the stock goes down. All right. And we'll get into a little bit more detail as far as how all that works and how that plays out. And then you can also sell options. Now that's a little bit more advanced. We won't get into that right now. That's going to be something that's going to be a little further down the road. But there is you do have the capability of selling options. And you'll find out later in the discussion, because when you buy an option, there's always someone on the other side that's selling you that option, right? Or selling you the rights to those shares. So keep that in mind, but that's something a little bit advanced. You can sell options. So keep that in mind, okay? Any questions? Anybody got any questions about what I just said? Don't be afraid. Don't be afraid. Any questions? No questions? Moving right along. All right. So what is an option, right? And we explained it a little bit. Now we're going to go into a little bit of more detail. So right here, you have you buy the rights, but not the obligation. So pretty much you buy the rights of the actual shares. You're actually renting the shares, right? So you're renting the shares of that contract to buy or sell at a specific price before a specific date. So basically you're renting 100 shares at a time for each contract for a specific price that you can sell at any time before a specific date. That makes sense? So the buyer seller, just like I just said, every time you buy an option contract, there's someone on the other side that is selling you that contract. Okay. So there's always someone on the other side. So there's always someone on the other side of the deal who you will never know. You'll never know these people. You could very well be buying from your neighbor and you not know it, because there's always someone on the other side. And they are either selling you a call or buying your put. And basically everybody's just trading paper with no ownership. And we'll get I know it may sound a little confusing, but it'll come all together in a few seconds, right? So someone is either selling you a call or buying your put. You're just trading paper ownership. You're just trading money on paper. You never own the shares. You're not obligated to the shares. You don't have to sell the shares back. You can let the contract go all the way to the expiration date. And once that expiration date comes, your contract is over with. So whatever money you got invested in it, it's best that you sell your contract before the end of the date. And we'll get into a little bit more in detail. Okay. So you have the strike price. The strike price is the desired price that you buy or sell the contract when you purchase the contract. So you'll buy the contract at a price point, right? And then you'll see in the next example, you're able to sell that contract at a price point depending on where you got it. All right. So each contract equals 100 shares at this price. So when you purchase, just like I said, when you either buy or sell When you purchase a put, you're actually selling, and when you purchase a call, you're actually buying. And again, with this next slide is going to break it down a little bit more for you guys. All right. And the expiration date is the last day you own the rights to the contract. That's the last day you have to sell that contract back before your expiration date. So you own the rights. Let's say you bought a call contract that expires on February the 17th, which is next Friday. So you have the right to sell that contract for any price you want, depending on where the market is, before the end of that day. At the end of that date, your contract is over with. So it's best that's why they have expiration dates, because they want you want to sell that contract before it expires. Right? So this is the basic lingo of options contract. All right. The first main thing we're talking about, a call option. It's also called a bullish move. And let's look at it as in positives and negatives. When you're talking about calls, you're always talking about a positive thing. So a bullish, a long move, this is all a positive move in the market. So if you buy a call option, you buy the rights to sell your contract at a certain price before a specified date. So when you buy a call, you believe the stock is going up in value. The higher the stock goes up, the more valuable your contract becomes, and vice versa. So basically, if you buy a call at let's say you buy a $100 call option on the stock at the $100 strike price. If that stock goes up, above $100, your contract is now worth probably maybe $150 or $200, depending. The higher it goes up, the more it can go. A $100 contract can turn into $1,000 profit if it goes up higher enough, right? So, and just like that, just like I said, vice versa. Now, if you buy a call option and the market starts going down, you're losing money the further it goes down. Now, you can only lose what you put in, so you can't go in the negative, but your gains are unlimited. So if you got $100 in it, you can only lose $100. You can't go in the negative as far as owing more than what you put in it. So if you buy a call option, a $100 call option, you betting that it goes up. If it goes up, you win. And the key thing about it is you can sell that contract back at any time before that expiration date. So if you buy a $100 call and it jumps up $10, you just made $50 on that contract. You can sell then. If that contract drops down before you lose the whole $100, you can sell before then as well, because you're trying to cut your losses, right? And just as well as the call, you got the put option. The put option is the exact opposite of the call. Bearish, when you hear words like bearish, that means a negative word. Short, that means negative. It's all about going down. Call, bullish, long, those terms are used when you're talking about positive aspects of the market. Put, bearish, and short, they're words that are used, we're talking about the negative aspect of the market. So on a put, you buy the rights to sell your contracts at a certain price before a specified date. When you buy a put, you believe the stock is going down in value. The lower the stock goes, the more valuable your contract becomes, and vice versa. So if you buy a put option and the stock starts going down, your contract is gaining more value. You're making money. If you buy a put option and the stock starts going up, guess what? You're losing money. So everything is a exact opposite, direct opposite of each other when you're talking about the market. That's why I said in the option, you can make money or you can lose money no matter the direction the market is going. It just depends on the position that you're in. It depends on whether you bought a call or whether you bought a put. Okay. Now the strike price, this is the certain price. The strike price is the price point that you agree to buy or sell the shares, which is 100 each. The contract, basically shares of a contract before the specified date. So you're buying the shares at a certain price, and that price is the strike price. And if you got a call, you got $100 call, your strike price is 100. If your stock is going up over 100 or up near 100, your contract is gaining more money. If your price is going below or down and you're in a call, your contract is losing money. And the expiration date, that's the specified date that you must buy or sell the contract. In other words, settle up. It's like, just think about it as a real estate closing transaction, like a closing date. All right. You got a seller, you got a buyer. You buying a house, you got a seller. You say, okay, I'll give you 100,000 for this house. The seller say, no, I want 120 or whatever. And let's say the market goes up and down between that, and you come to an agreement. Okay, we got to close. And when you get when you get a loan for people who bought a house, you got a certain time before that loan it got to come due before you have to go back and do your paperwork over. So the closing date is almost the time when you settle up, where everybody pay everybody. So when you buy a call, and this is the next slide is going to show you. So you buy a call option, right? You bought a call, $120 strike price, and the expiration date is 30 days from now, right? So you bought the call at 120. The stock goes up to 135. You just made $15 per share. So this is probably like $150 move, because remember, option contracts are 100 shares. So the 100 times 15, that's $150 move on a per contract. And you can buy as many of these as you want. You can have $120 calls with a 30-day expiration date. And you just made a $15 on each share. That makes sense? So that's why the call in the stock market is doing exactly what you want it to do. It's going up. But now, so when, just like you said, you can buy or sell it back. So you bought, this is what the option in a nutshell is. You bought the contract for 120. And with the agreement that I can sell this contract for any price I want within the next 30 days. So as this stock goes up, right, you have the option to sell these stocks for 135, even though you bought them for 120. That's how the options work. And just like the flip side. So just say you bought it at 120 and the stock goes down to $20, when it goes down to $100. So now you just lost $20 per share. So that's why you want, so now you're selling, and you want to sell it as close to 120 as possible, because that's your break-even point. Anything above that is a profit. Anything below that is a deficit. That makes sense. So the strike price is kind of like your break-even point. That's where your contract is going to stay the same amount, whatever it costs. Anything over that is a profit. Anything under that is a negative. Now, you can also buy. We'll get into the in the money and out the money, but in a nutshell, this is how stocks break down. You get the difference times 100 if that stock is moving in the way you want it as a call option. And just like the exact opposite of it, you got a put option. Let's say you buy a put with $120 strike price, right? For the expiration for the next 30 days. You bought it at 120, right? It drops to 100 on the put. You bought the option to sell these shares for 120, even though they're worth 100, because now the stock has dropped, and that's what you wanted it to do. But you got a sale price of 120 when it's only $100, so you get the difference. But just like the exact opposite on the call side, say you buy a put option, $120 strike price, 30-day expiration, and the stock starts going up. Your sale price is 120. Now the stock is worth 130. So guess what now? You're down $10. Because now you got to buy that contract back, or pretty much settle up with a $10 increase per share. That's why the more it goes up, and you can sell it at any time. If it goes up $1, you can sell it, and you've only lost $1. If it goes up $2, you can sell it. And just as well, if it goes down $1, you can sell it. You made $1 because you want it to go in. The put means you want it to go down. You have to look at that U if you look at that U, and if you look at the A in call, well, let's say a capital A, that's like a point up call. You want the stock to go up. Look at the U as it going down. That means you want it to go down, and you take the difference. Any questions? I know somebody got some questions. No questions? Okay, we're carrying on. Here's some more lingo as far as, because you got to know, because it's all about the jargon and about the terminology that they're using when you're talking about options. You got in the money. So in the money is a strike price that's below the actual stop price in a call contract or above the actual stop price in a put contract. The more in the money you are, the higher price the contract. In the money means, because you got to think about it, if you're in a call contract, you're thinking that the stop price is going up, right? You can buy a call or put at any price, any strike price. So if the stop price is trading at $100, you can buy a $1 call. You're already in the money because the stop price is already over $1, and it's already in the direction that you want it to go in. Because if it's at a 100, you could buy a $100 call, and it's going to cost you a lot of money because you're already in the money, right? Because the stock price is already above. And put the same way, if the stock price is already below, the strike price is already below the contract, then you're in the money because it's already in the position that you want. Does that make sense to everyone? All right. Out of the money, the exact opposite. If you buy a call and the stock price is at 100, you can buy a $150 call. Because guess what? Now you're out of the money. That means you're above the actual stock price. That's out of the money when we're talking about contract. And you're the same thing with a put contract. If you're already below the strike price, the contract is considered out of the money. The farther out of the money you are, the cheaper the contracts are, right? Bid and ask. Bid is just the highest price a buyer will pay for to buy shares. So that's the highest price that you can pay for them. And ask is the lowest price a seller can sell. In a nutshell, and the difference between these two is called the spread. So basically, in a nutshell, every time a stock is sold, somebody is getting a profit. You can buy a stock for $2 and then it will only sell back for $1 in some instances. Just think about it like that. It's always someone getting a profit, right? We talked about the candles. That's how the price movement is measured in increments of time on a chart, right? So you got time decay. Time decay is the depreciation in value of your contract as you get closer to the expiration date, right? So the closer, say your expiration date is February the 17th. And let's say your stock doesn't move at all. It just says it stays at the set price for the whole week. Every day your value in contract is going to go down because you're getting closer and closer to your expiration date. So you have to keep that in mind when you're trading by buying contracts that are close to expiration, because they have what they call time decay. And the closer you get to the expiration, the lower your prices. It's not a big, it can be significant depending on the contract and a couple of different variables. But keep in mind that the closer you get to the expiration date, the lesser and lesser your contract starts to dwindle away. So a lot of times my main goal is to take profit every day. My main goal is to get in and get out. All right. Where am I at? Stop loss. Stop loss is a preset price point used to enter and exit stop positions automatically. So you can set a stop loss to say, once this stock gets up 10%, I want to sell. And guess what? Once it get to 10%, it'll automatically sell and you're automatically out that position. You also can say, well, I want to set a 20% loss. Once I lose 20%, I want to automatically sell and get out of that trade and cut my losses and go on to the next. So you can set preset price points to kind of buy and sell your position whenever you want to, based on percentage wise. All right. Opening and closing bell. The stock market opens at 9:30 a.m. Eastern Standard Time and closes at 4:38 p.m. Now keep in mind, when you're trading options at 4 o'clock, you can no longer trade options. They stop being able to be bought and sold. They stop like 30 minutes early. And this is Eastern Standard Time. It doesn't matter where you are in the world. 9:30 a.m. Eastern Standard Time, you got to be up in front of that computer, or if you're in the stock market. Think about the people in California, they have to be up at 6 a.m. to get ready to get in the stock market that opens up at 9:30 on the East Coast, right? All right, day trade. A day trade is a contract that is bought and sold in the same day. I do a lot of day trading when I can. I try to take my profits and get in and get out. A swing trade is a contract that's bought one day and sold the next, as long as it's before the end of the expiration date. So I can buy a contract, like I got a couple of trades now that I'm in, that I swung. It's called a swing trade. I'm swinging through the weekend. So I'm gonna swing them to Monday, or you can swing them for a day, or you can buy contracts. So you can buy contracts with expiration dates as far out as 2025. That's called a long swing, right? That's called a long swing. The contracts I just bought Friday are going to swing to Monday. That's called a short swing, right? And this is kind of like the in the money, out the money. This is an example of what a option chain looks like. This actual stock, I think this is Tesla. I think I cut it off. I think this is Tesla. Yeah, looks like Tesla. So just like this side is the calls, this side is the puts. This is your strike prices in the middle, right? Tesla is trading at this time, was trading at $194.58, right? So you also have what they call at the money. At the money is right here. You see this blue side, all the blue on the call side is in the money. The blue on the put side, that's in the money. As you can see, these contracts are more than these. All right. So at this strike price at 192.5, to get a call, it will cost you $10.30 a share. Somebody tell me how many shares are in this contract?
Is it 192 in this?
That's 100. That's 100 shares in that contract. So for this contract, each share costs you $10.30. This contract is going to cost you $1,030. This contract is going to cost you $890. This one is going to cost you $770, $660, $560, $475, and so on and so forth. And the reason why it's in the money is because, just like I said, this is the stock price, 194.58. Everything above, it's already in the call position. It's already above. When you buy a call, you think the stock is going up. These prices, it's already above 192. It's already above 190, 187. See these strike prices? These are the strike prices you're buying it. These contracts are already in the money because the stock is already above the price, already above the strike price. Now, if you're buying a call, because these stock prices are above the strike price, these are called out of the money. And you can, and this go all the way down to $1, and this go all the way up to about, $1,000. Like, it goes all the way up. And as you go further and further away from the price on the negative side, right? Because this is higher, the price gets cheaper. As you go lower and lower, because that's up under the strike price, the price gets higher and higher because you're already in the money. The stock is already sitting below the strike price or above the strike price in the call setting, and it's already sitting below the strike price in the put. So these are puts. So these are ones you think that the stock is going down. So this is 182.5 is already below 194. That's why this is so cheap than it is from 205. That makes sense to everybody? No questions. Anybody got any questions about in the money, out the money? No question.
I'm totally confused even how we even get to the point of even being in the money, out the money, to the call and to the put option and everything. So I know you said, and I know you know what I'm saying. It just I'm confused.
Okay, in the money. All right. So when you're talking about a call option, right? You're betting that the stock price is at 194. You're betting that the stock is going to go up from 194, right? If you buy a 182 call, meaning you think the stock is going to go up from 182.5, the reason why you're in the money is because 182.5 strike price is below 194. So it's already above 182.5. So in essence, when you buy a call, you want the stock price to go on the call side. You want the stop price to go as farther up away from this number as possible. And the farther up away from this number on a call option, the more money your contract is worth. The farther away the stop price gets away from your stop price, gets away in the positive position, the more your contract is worth. For example, that's why a 192.50 call contract is 1,030 and a 190 contract call is 1,185, because 194 is further away from 190 than it is 192. And the ones that are out of the money, it's because the strike price is above the stop price. So it hasn't got to this point yet. So the further you go above the stop price on a call, the cheaper the contracts get. See, this can go all the way out to $300-400, which is way above 194. So the farther you get away from the stop price, the cheaper your contracts are. And that's called out of the money. If you're below the stop price, and when you're talking about buying the contract, see, each contract is a strike price. You can buy a contract here. This is a contract price. And on either side. So you can buy a 182 call and you're betting that the price is going up. You're going to pay $1,730 for it. You can buy a 182.5 put for $245 and you think the stock price is going down, right? It's worth $245 now. It's because this stock price is above on the put. But just think about it. If the stock price get to 182.5, this contract is going to be worth over $1,000 from here, the put. Everything is flip-flop. This side, you want every time it goes up, everything on this side goes up. And this goes down. And every time it goes down, this side goes up, this side goes down. It's kind of like a wash. So the market, that's how the market works. The strike price is here. This is the price point that you're pretty much placing your bet on. I'm betting at $190. The stock price is going to go up even further away from 190. You would bet a call. Or you say, well, I bet 190 strike price down. I think it's going to go down. You will buy $470. You'll pay $470 for a put. And this is the expiration date right here. So these contracts are good to February 17th, 2023.
So you can buy both. You can buy the call and the put.
You most definitely can.
Okay, so with that being said, my understanding, what I'm gathering you saying is the strike price is the 182. Just say number one. The strike price is 182, right? And the buyback is 100 shares at $17.30 a piece. So it's $1,730 to buy those 100 shares. And since it's already above the amount that each share is priced at, it's already above the 182. The more it goes up, the more money I make.
Correct.
And we got a deadline set for by February 17th that these options is available. So by whatever the price is around February 16th, we need to sell if you're making some money.
Yeah, hey,
right?
It could be the same day. You could buy this contract right now. In 5 minutes, it go up $5. You can sell it right then. You buy the right to sell that contract at any time, no matter it go up or down. Because see, the thing about it, let's say you spend that $1,730, right? And you got a call, and it start and the stock start going down. As the stock going down, you losing money because you better call. But at any time before you lose it all, you want to sell it. So you can sell it right then, whether you lost $100, or you can gamble a little bit more. You might lose $500, or you can ride it all the way out to the 17th and lose it all. You see what I'm saying?
So,
go ahead.
So with that being said, what happens after if you decide you're gonna keep it in and you're making your money that you need to make and you see it going up? What happens after the 17th with your at the end of the 17th? Do you lose everything, or are you able to does it automatically rolls over, or what happens at the end of the 17th?
Great question. Now it does. Now the thing about it, if you're in a good position, again, like if we go back to let's go back one slide. Remember this right here, time decay. So the thing about it is, if it gets all the way to the end, and it still can be worth some money, it still very well could be worth some money. But that's something you definitely don't want to do, to be honest with you. But I have had it, because this contract can go all the way to zero, but it also can have some money on it. And more times in the TD Ameritrade, the platform I use, if any contract is left, they will put it back towards your account. I have seen it done, but I wouldn't leave that up to chance. I would take care of my business and sell my contract before this expiration date, because I'm not going to leave it up to them to say, well, here go your money back. All you got to do is just sell it. If that, you know what I mean? But in the event that the contract is worth something and your expiration date comes, the trades are automatically reverted back. But I guarantee you it's going to be less than this 1730 if you get to that, because time decay is going to kill it. The closer and closer you get to your expiration date, time decay plays a factor in it as well. No, and the price always plays a factor in it. The price is the #1 factor in how much your contract is worth. But time decay is also a factor. As you get closer and closer to the 17th, you want to be trying to take your profits or cut your losses and get out that trade and go on to the next.
So this really is something that you need to watch all the time to see where the market is, so you know, oh, I made a $5 gain on each one of my shares. This might be a good time to get out, or everything is falling. This might be a good time to get out, or this might be a good time to buy the put.
Yep.
I see that it's dropping, so this might be a good time to buy a put, so I can make money on the back end of the put.
And see, the thing about it is, and what I found out is, I spend probably about 2 hours in the morning, and I would say by lunchtime I'm done trading for the day, because I'm not trying to get greedy, because if you can get greedy, you can buy this $1,700 put, and look, it, as you see right here, this stock is down $2.31. If you bought this and it dropped $2.31, you probably lost about $300-400. If that, you maybe $100, maybe $200. You know what I mean? If it drops $2 and you pay $17.30, you probably lost a couple $100. You see what I'm saying? So you want to be in control, you know what I mean? But you got to the 17th, because I done seen where it could drop $2 and go up $10. Now, and that's when you get into learning some. We're gonna get it deeper, a little bit more detail, your technical analysis, your fundamental analysis, and understand what the indication is going to show you of what this stock is about to do. Why is it moving like this? And they got some pretty good indicators. There's a lot of stocks have a lot of moving parts, but for the most part, they don't. Most part, you got the meat and potatoes. You got to understand what goes up must come down, and what comes down must come up. It's just like a heartbeat monitor. You see what I'm saying? And that's why I tend to buy stocks or buy options with further out expiration dates. That way I got time for the stock to move a little bit.
Lamar,
So
can I add on to what the conversation was saying?
Sure, go ahead.
So that's the beauty of this. So the way that my friend had explained it to me, and it really just made more sense. Imagine that you are the middleman between somebody buying a house and you are getting the contract. You're like, okay, maybe this house, you bought the contract and you say, oh, this house is going to sell for $180,000. And that's what your contract says. And you go find a buyer and you say, hey, this house right here is going to be $180,000, right? And I have the contract for $180,000. Say the market changes and the house is now worth $200,000, $400,000. But you have that contract that said that it was worth 180 and that bank was going to lock in. So you're just trying to find the right person you're going to bid your contract to at the end of the day.
Yep.
And if you wait to the date, what sucks is that, hey, well, you bought the contract. Say if you didn't find somebody to flip your contract over with, well, guess what? You end up with the contract yourself. So the goal is to get your money. You get in and out.
Yep.
You get that money and you out.
Yeah, sell that contract. Don't get caught with the contract. Don't get caught with the contract It's kind of like don't get caught driving with an expired tag on your car. You're good up until that date. But when you get to that date and the police pull you over, you in trouble. If you get to that date, you generally want to get the tag before your date to come, right? It's the same thing with this contract. You want to sell this thing well before it comes to expire.
And to add on to that conversation with that example too, the way that you are in trouble if you wait to the date is if you start using leverage and you got stuck with the date and then you basically bought a contract with money you didn't have. You know what I mean?
Mm-hmm.
That's where the trouble comes, because then now you're putting yourself in a situation where you're putting yourself at risk.
Yep. Because again, you got time decay. You got the market that could go the opposite way. See, time is not your friend when you're talking about contracts. Time is not your friend. If you buy this contract is worth it's kind of like a tree. These contracts are worth. It's kind of like when you should have planted a tree. The best time to plant a tree is today, right? And if you had this contract 20 years ago, it probably was worth $1. Now it's worth $1,700. It's all about when you get the contract and when you sell it. The quicker, the better in most cases. But again, you can buy a contract that has a 2025 expiration date and you can hold it for a year. You still have the rights to that contract all the way to the year. And we'll get into a little bit more detail as far as the expiration date. But these expiration dates go out, and the closer to the expiration date, the cheaper the contracts as well. So if you buy a contract that says 2025, this contract might be worth $17,000. Because they know this call, they know in 2 years from now that this price is going to be well over 194. It's going to be well over 182. So this contract is going to be worth way more in 2025. And if you're the lucky one holding that contract, when this price goes way up to $200-$300, you had a good day. All right. Any more questions? Anybody else got some questions? All right, moving right along.
So how you go about picking your stock and what platform is the option sold on?
All right. So I use TD Ameritrade and Thinkorswim. TD Ameritrade, Thinkorswim, they're the exact same thing. Thinkorswim is a little bit more user friendly, has a lot. You can chart a lot better on Thinkorswim. I like Thinkorswim and TD Ameritrade. When I say Thinkorswim and TD Ameritrade, I'm saying the same thing. They just have two different apps. So I like TD Ameritrade for one. They have education. They got tons of free education. I learned most of this stuff I'm telling you guys from TD Ameritrade education tab, like tons of YouTube as well. You know, I got a lot of people I follow, a lot of people, and that's the main thing about this industry, about this trading stocks. How I pick my stocks, it's almost like asking a pitcher, how do you know when to throw a curveball or when to throw a fastball? It's pretty much like keeping your ear to the ground. The news is a good element. A lot of people, an old saying in the stock market says, sell the news, buy the rumors. By the time it hit the news, it's about too late. But you can use the news as watch financial news. They'll give you a lot of different pointers. And once you get into it, and we're going to get into charting, you start seeing how the stock sets up. Because again, what goes up must come down, and what goes down must come up. That's everything. And you just got to find the right position. You got to find the right position to get in. Because just like even here, because just like these strike, these are $65 calls. Look how much these are. This is on Tesla. You see that? That's $13,000 for a $65 call. Why is it so much? Because the stock price is at 194, way above 65. And the farther up it get away from 65, the more this stock is, the more this contract is worth. But just like we said, you got to have a buyer and seller on one side. This bid and ask, this ask and bid, this is what you buy it for. This is what you sell it for. So when you buy this contract, you're automatically down by it. You're already down. Because someone is always making profit. But as you see over here, this contract is $1, but this says 0 over here. That means there's no one else on this. There's no one on the other side of this contract. If you buy this contract, you just spent the $1 and you guess what you get back? 0. that means that no one is on the other side. And I know it may sound confusing, but every time you buy a contract, there's always someone on the other side. Unless you see this. If you see 0 and you see a number over here on the ask is what you pay for it. The bid is what you sell it for. If you see 0 on the other side, that means no one is on the other side. That means you the only one, you waiting on somebody to come buy this contract. And trust me, ain't nobody coming to get no $65 put on Tesla, because they know ain't no way Tesla going back to $65. The contracts kind of tell you where the market going, because if you see these things super high on the call side, it generally means that you have a bullish market. You see the put start going, getting a little higher, that means you got a bearish market. Just like Friday. Friday, the market was red the whole day.
Lamar, to add to your point too, because I know you mentioned a really good point earlier about it like you could get a contract that could be a year or 2 out. And that really ties into really understanding where the economy is going to. People who choose those contracts that are a year, 2 years out are people who are looking at the mass influx of what's going on. So looking at Tesla had the dip. Sitting and understanding why Tesla had a dip, whether it was just a Tesla problem or was it we're going into a recession because everybody's holding back problem. Making calls like that really help determine what's really going on. So does Tesla have any competitors going out on the market right now? Who else is trying to do the innovative technology with electric cars or hybrid cars or hydrogen power cars? You see what I'm saying? So if that's within the industry, how is that industry changing so that you keep a contract long term? And that's where sometimes people get a bigger bang for their buck if they're going to be analyzing the market long term. And if you get a contract that's really far out, you could do an in and out along the way.
Yeah. And just like he was asking, I think he was asking, so you mean you can buy a call? Let me go back to the first slide. You can buy a call. You can buy a call. You can buy a call and a put. So let's say right here, this is the time that I don't know if y'all guys can see that. This is 9 o'clock. So say if you bought a call right here at 9 o'clock, the stock goes up. You sell right here. You get your money. You make your money. Then you say, okay, now I want to buy a put. You can buy a put right here and it goes down. Then guess what? You take your money. Then here come these green candles again. You can do this all day if you got enough capital. You can sit there and watch the market, because this is what the market does. The market goes up and down, up and down, up and down. And basically you just got to find you got to learn the traits of the stock. Me, I've been watching Tesla for so long. You start understanding how it moves. Also, by trading stock, you become more informed about what's going on in the market. You start watching business news. You start, pay attention to what's going on. Even like, how Elon Musk just was on trial last week about some tweets he made that caused Tesla. He beat him and Tesla jumped 10 points in one day. Like certain stuff make it move. Elon, he's a shaker and mover of the masses with one tweet. Sometimes he did it with Dogecoin. There's a lot of different variables that make a stock go up and down. And that's what
the union address too. State of the Union address, when they're gonna do a flip on the interest rates, the market's either gonna go up or down. There was another one that happened the other day that I caught was it's just you start picking up on the market around 2 o'clock. If you pay attention, that around 2 o'clock our time, you're looking at a little rush hour. Usually things go up around 2 o'clock.
Yep. And when I've seen at 2:30, they start going down. So the market has trends, it has traits, it has different things that it characteristics that it often used so often that it's a trend. Like they have a book that I use often is the Stock Almanac. It can tell you everything about stocks, because stocks are pattern. There's an algorithm almost, and they work in the same facet. Unless we have something catastrophic like a recession, something terrorist attacks, a national disaster, generally the market is going to move just like it's always moved for the last 200-300 years that it's been in existence or whatever, right? So you just got to understand this. It becomes like a hobby / job almost. I'm usually at work watching this on my phone, and that's the thing about it is I think you made the point. Well, so I got to be watching this. But if you don't go anywhere without your phone, like most of us don't do, you got the stock market right at your fingertips. And it's just a click of a button whether you get in and out of trades. I've made money, and I don't suggest texting and driving, but I've made money on my way to work, on my way to work in the morning, getting in and out of positions. You know, it's just that simple. It's not hard. It doesn't take a lot of time. It's just about getting the knowledge, and by being on this show, on this course, you're serious about what you want to learn. It doesn't, if we can you know, tweet and put Facebook posts and memes and watch TikTok throughout the day, we can do this as well. Like, it doesn't take it. And once you understand the basics, and that's one of the reasons why we have this, is learning the basics, learning the terminology, learning what a call, what a put is, what a strike price is, what an expiration date, what is time decay. Like, learning these things and understanding, because it takes time. You're not going to learn everything you need to know in this call today. And it's going to take some effort from you. Like, you're going to get you'll get probably 30% of what you need to know about the stock market from me. The rest of it, you got to go out and try to find. You got to go out and research and look into different things. Like, especially when companies release their earnings, when they release their projected earnings, that determines a lot of things about the stock. You'll start getting yourself involved in things that you normally didn't look at. And it's amazing. It's fun at that. I've never seen weeks go by so fast since I've been trading. I love Mondays now. I hate Fridays now, because I'm ready to get in and see if I can't make some money just by tapping my screen. And it's a good day when you can make, if not more money, if you're making on your job. I'm not saying go quit your job, but hey, you can supplement the hell out your income by just making a few trades a week. And get in the right.
Shoot, I caught $300 out of 50 in on my hour break.
Mm-hmm. It can. You just got to get in the right position. And again, like I said, the ask is what you pay for it. The bid is what you can sell it for. And the difference between it is the spread. Oftentimes when you see contracts with huge spreads, like, these are pretty nice spreads. They're not that bad. But sometimes you'll see this say 132 and this say 90. Now, those contracts move if you're in the right position. But buddy, if you're in the wrong position, you're going to be down real quick. But that's just kind of giving. And the puts are always going to be on this side, and the calls are always going to be on this side. And don't do like I did Friday. Thought I was buying a put, and I bought 2 calls, and I'm looking crazy this weekend. That's why I'm swinging that trade I got, because I'm looking crazy. I tried to buy some puts in Tesla, but I was moving so fast, and I bought calls. And Tesla tanked on Friday. So I'm down about $200 in a trade that I hope go the other way Monday. All right.
So can you do this with cryptocurrency as well, or just stock?
Nope. Crypto does not have options.
Okay.
Crypto does not have options. Options are only traded on the open market, Dow Jones, NASDAQ, S&P 500. All right. So why should you put your money in stocks? Here's a prime example of why you should be involved in the stock market, at least buying shares. We talked about buying shares. Here's a few shares that I got in my portfolio. OPAD, which is a chip company. SEV, I think my man Brandon told me about this, is a competitor of Tesla. And SNDL is a Canadian cannabis stock. Now, just using the example of OPAD, I made, this was on Friday, I made 15% profit. As you can see, I bought these. Well, I'm down really, but I made, because I bought them for, I bought them for $93, and they're down 87 cents. But they came back up 15% yesterday. So look at this, 15% of $113.11 is $15.32 or 33 cents, right? So just think if I had to put $11,000 in that, 15% still is 15%. That'd have been $1,770, right? So, but here's what the bank does for you. The bank, if you put that same $113.11, the bank gives you 0.01% annual return, and they don't care how much you get in there. Under 10,000, 10 to 24,000, 25 to 50, they're still giving you 0.01% interest annually. And guess what? It would take you 1,533 years to get a $15 return on $113 in the bank. If that don't make you, the hair on your neck stand up, I don't know what will. And the bank, guess what the bank does? The bank takes your money and buys options with them and buys life insurance and get a rate of return of this, and give you this. 1 cent is the rate of return on $113, 1 penny. That's why the stock market is so important. And people are, I was listening to a clip the other day. People say they always are so skeptical about being scammed. He said scam means still confused about money.
Most people, they're passing over the opportunities repeatedly because they're thinking everything's a scam, not realizing scam stands for still confused about money. And then you like, oh man, this sounds like a scam, it's a get rich quick scheme. I'm like, you better hope it's a get rich quick scheme because you're not going to be here long enough to get rich slow. I've never seen anybody do it. I'm like, and just think, have you ever seen anybody do it the slow way? I haven't. Like get rich quick. I'm like, who you seen get rich slow?
The stock market is not a scam. The bank is your biggest scam. The bank is. They take your money, lend it out, charge interest on it, and give you this is not 0.1%. This is 0.01%. This is less than a penny, people. This is less than a penny that they're giving you return. And that's why it's important to get into the stock market. Anybody got any more questions?
I think I got a little bit confused when you were just explaining that left side. Because it seemed like you saying that you getting back less than what you put in.
What, this
on
right
that
here?
OPAD. Yes, sir.
Okay, so when I bought this is the cost. I paid 93 cents for OPAD. The day before this, OPAD dropped. OPAD dropped down to like 80 cents. So I was down. Now I'm down like, what's that, 6 cents a share? So I'm down 6 cents a share, but I got back 15% on this day. This is the daily gain. But overall, I'm down 6 cents. It really was down below this. You see what I'm saying? It was down, but it came up 15% in one day.
So this was a call option.
No. These are just shares. This is not options. This is just shares. I bought, each share cost me 93 cents. So these are just shares. Back to the options are when you buy the contracts. Shares is when you actually go and spend the money for the share. Just like if we go to like if you bought 1 share of Tesla, it would cost you $194.58 according to this chart. You would spend $194.58 for 1 share of Tesla. Right? But if you buy a contract, remember, you don't own anything, you don't own any shares when you buy the contract. You're just renting them. So you're renting the rights of 100 shares for a period of time. But what I was just showing you as far as why it's important to invest in the stock market is because the bank is only giving, if anything else, if I would have put my $113, I would this really what the example was. If I would have put my $113 into my savings account and let it sit there for a whole year, right? Where is it at? I went back too far. If I would have put my $113 and let it stay in the savings account for a whole year, I would have got 1 penny returned on it. Just 1 cent for a full year sitting in a savings account. But by having that same $113 in OPAD stock, I make 15% on Friday. And I'm willing to
really get a lot.
Yeah, compared if I would have had it in the bank, this is what I would have got. And that would have took a whole year to get that. But by just having that same $113 sitting in a stock, I made $15, which it would take me 1,533 years to get $15 on that same amount of money sitting in a savings account.
Gotcha.
So this is why it's important to invest in stock. This is why it's important to at least have something. Like it, as you can see, it ain't like I'm rich, y'all. I ain't got no, it ain't like I'm a guru. It ain't like I'm the know-all and be-all of stocks. But I understand that this is a better vehicle than this. Even though I'm down a little bit even here. But this is better than this. If you're gonna give me 1 penny, I might as well keep the money in my mattress. You know, I'm not saying just close out your bank account, but I only got enough just to pay my bill. The rest of it, I'm trying to maneuver over here to where it can grow while I'm sleeping. And guess what? TD Ameritrade is a national branch bank. You can use it just like your bank. You have access. If I want this $113 Monday, I get up, I sell this. I can sell all 130 of these shares, and I got my money. If you got $10,000 in here, you can get your, like, you got $10,000 over here. You probably can't go get cash money out the bank. They might give you 10. They might. Because they ain't got the money. They done sent your money out the door. And the rest of the money just numbers on the screen. So why not be in control to where you can get maximum return? All right, homework. These are the apps I use. TD Ameritrade, Thinkorswim.
Hey, Lamar, I got a quick question in regards to the Ameritrade and the Thinkorswim. And you may have answered the question earlier and I may have missed it, but is there a cap on how many calls or puts you could put? Like, for example, Webull caps me at a certain amount of calls or puts that I could do within a week.
TD Ameritrade, I've traded on Robinhood. I've traded on Webull. I know on Robinhood they only let you do 3 day trades a week. If y'all remember, day trades are trades bought and sold in one day, in the same day. But in my experience of being a TD Ameritrade for the last 2 years, I've day traded sometimes every day of the week, no penalty, no red. I've done it several times. Me and my son had that conversation, like, why does Robinhood and other platforms? Because you got to think about Robinhood, Webull, all of those guys are like third parties. TD Ameritrade is a direct broker. See, Robinhood and Webull, a lot of times you can't even get your contracts filled sometimes because they sometimes I've had bad experience trading on Robinhood. I tell you that. I'm nothing against it, but TD Ameritrade, to answer your question, I could do as many puts and calls I want as long as I got the capital. The only thing about it is, let's say if you buy a contract, say if you got $500 in your portfolio and you buy a contract for $200, and then you turn around and sell it an hour later and you make $300, right? You can't spend that $300 until the next day. Until once you day trade, that amount of money is not accessible to the next day. No profits can be taken into the next day. So in essence, a lot of times, especially when my account is not as large, I'll run out of trading power, as they say. Because once you use up your trading power, if you got $500 and you done spent it all on contracts in one day and you sold and you made money, you could have made $1,000. That $1,000 won't be accessible to use until the next day. But to answer your question again, like, I've never been penalized for doing multiple day trades a day, like five. No, I've done at least 5, sometimes 6, 7, 10 trades a week, day trades. And unlike Robinhood and Webull, they won't even allow you to make the trade. But TD Ameritrade, no, they do not stop you from making as many option trades as you want, as long as you got the capital to support your trades. But yes, download these 2 applications. That way we can follow each other. You know, you can follow along what I'm saying a lot more. You can see a lot more visual stuff, that everything looks the same. If you guys are using Robinhood, you're using Webull, that's fine. I like this platform better, for one, just like the caller just said, that there are restrictions on what you can do. I know for sure Robinhood only allows you 3 day trades a week. and after that, they won't allow you. So, and I think you had to have your portfolio over $10,000 in order to do multiple day trades, to do more than 3. So, to answer your question, no, they don't. Anybody else got any other questions?
You did mention that on TD Ameritrade you can pretty much practice with the paper trade.
Correct. And that's one of the main reasons why I like the Thinkorswim and TD Ameritrade too. Again, like the TD Ameritrade, I like more to like kind of do all my, because there's certain things you got to do when you start. Like I like to create my profile on TD Ameritrade. That gives you everything. That gives you, it's going to give you an actual routing number. It's going to, and you have to put your banking information that you want to dump money from to put in there. And it has all the education. It has all the good stuff on TD Ameritrade. On Thinkorswim, I like the charting. I like how it looks. I like the fact that you can do the paper trading on the Thinkorswim. So you can do practice trades. They give you like $50,000, $20,000 or $50,000 of monopoly money, and you just trade just like real time. And it's only can be traded in real time. Like you can't trade like now because the market's closed, but you can trade with paper money during the week with money that's not even yours. And it kind of gets you adjusted or gets you more confident before you actually start investing your own money. But if you can see here, did I go there? Hold up. Where's my, did I do it already? I think I deleted it. Yeah, that's it. So as you can see here, even this contract here, this contract is $1. Well, it's $2 right here, the X. So you can buy contracts a little or nothing. Now I wouldn't buy this $95 put, but this is kind of something that shows you, you know, you can it could be very inexpensive to learn. A couple dollars just to see how it works, right? So it's the paper money is great because then you can use, you know, you can buy multiple contracts. You can see how it actually works when you got some real money on the line, and those that 6% of $10 doesn't compare to the 6% of $1,000. So, but it's all about percentages. I want you guys to know that the dollar amount is not that big of a deal. If you're getting 10, 15, 20, 25% return, you're doing better than most. And don't look at the dollar amount, look at the percentage. All right, I want you guys to download GroupMe. GroupMe is where, you know, you can give all your questions, all your help you needed, anything. We'll have our discussions in there. If you don't like group chats and group texts, I wouldn't suggest being a part of it because I know sometimes they can be challenging, but I just silence mine when I'm busy working or whatever, and then back to it. But GroupMe, that's what I'll be using to kind of communicate, answer any questions. And that way everybody can put their questions in there. Because I promise you, if one person has a question, everybody probably have that same question.
And the beauty of the GroupMe too is like, ideally, we want to get to a point like right now of us, there's how many 5 participants in the call. The thing is like, can we get to a point where we're cycling through the day and honing in on places within the market that we could tell each other, hey, like this is where we should be jumping in and do a call, or this is where we should be jumping in to do a put. Because once we get to a point where we all have the terminology down, where we all have a basic understanding of willing to take a risk, that's where we start really watching out for each other to come up.
Yes, makes sense, because that, you know, and that's the whole goal of this group, to actually educate, help people learn this trade, right? And also help each other, because someone asked, said, well, Lamar, how do you know what stock to get in? Me and my son, I have a 23-year-old son who actually got me started into this during the pandemic. And me and him talk. That's my broker. That's my guy. Me and him, we talk every day. We talk shop. We talk stocks. We talk. He's into something that's a little bit farther than he's into trading futures. Futures are another kind of like an options, but that futures, they trade 23 hours a day. Like they go from 5 p.m. all the way into the morning. Like, but that's a little bit more skill set that I don't think I'm not even ready for futures. But it almost seems too easy to be true. I have a little simulated thing that I'm trying to learn it as well now, but you know, you surround yourself with like-minded individuals, and you pick each other's brain, be like, hey man, I'm gonna jump in the Tesla call this morning, man. You know, and then if you but another thing I want to tell you that is that I found out, like when I first started doing it, I was following certain people and I was trying to mirror trade them, and I was doing the exact same thing they were doing. I don't want this group or this platform to be that, because I understand we could come together and say, hey, what do y'all think about this? And we can converse on it. But just being a part of a group where say, hey, y'all need to get in this and get in this and get in this, unless it's a collective effort where everybody say, hey, we ought to look at this. But just following someone else's plays, I wouldn't recommend it. Because for one, for me, I've had terrible luck with it. I've been in groups where people they say, hey, you need to get this strike price, this, you know, they give out plays. And then I get in it and they do the exact opposite. And now I'm down. And now I feel bad because I didn't took somebody else's word. I didn't do the research. I didn't really look at the chart. I didn't do my own technical analysis. I just went off what somebody said. And then I jump in a play and now I'm down. And it feels terrible. And I don't want to be able to put nobody in a position where, Lamar, you said get into a Tesla call. No, let's talk about this together. What do y'all think about a Tesla call? What do y'all think about a Microsoft put? What do y'all think about a Boeing call? You know what I mean? Like, I like to have a group collective as opposed to say, well, Lamar, what's the play for today? Well, I don't want you to bank your portfolio on my word. I want you to get comfortable and confident enough when you see something, you see the indicators that you learn here, you see the things that you've learned through your research, you be like, hey, this is a good position for me to get in and take the lead. I'm gonna tell you the number one thing that I want everyone to know about trading options. The number one thing to being successful at trading options is your mindset. You can do all the technical analysis. You can watch news from sun up to sundown. You can do whatever. But if you don't have the confidence, if you don't feel confident in what you're doing, you're not going to do well. And that's with anything, if you ask me. But I found out even now, I just got back the turn of this year, getting back into options. I develop a confidence. Now I have a little bit of know-how. I'm able to help others. I'm able to explain it to people. Now I have a confidence that when I get into play, I've done well. All this year has been a great year for me. You know, and I started off with minimum. I started with maybe $100, $150. And I grew my portfolio in a little over a month, over $1,000. Like, that's, hey man, I'll take that. You know, it's $1,000. I done took $150 and turned it to $1,000 in a little over a month. That's like, I'm talking about almost 1,000% return. Like, you got to understand, it's all about percentages. And if you do the same $50 a day, if you can make a $50 profit a day, that's about $10,000, $12,000 a year. If you can make $150 a day, I want to say that's about $25,000 to $30,000 a year. If you can make $250 a year, man, you in the six figures. Like, and people, you be thinking of little I'm telling you, it adds up. Compound interest. If you can do if you can do 5% a day, I'm telling you, that's well more than that bank account is giving you. Yeah, a lot of us, we spend that on Starbucks. We spend that on just buying gas, you know, eating out. If we start allocating just a little bit, I start out putting like $25 to the side, putting in my TD Ameritrade account to where I can start buying me some contracts. And I turned it to over $1,000. And I'm proud of it. I'm happy. And that's why I started this, because I want to say, hey, man, y'all need to look what I did. And I know once I get, because see, the thing about it is, once you start dealing with bigger numbers, you get bigger returns. And it all started from what, $150 for me. So even if I lose it all, at the end of the day, I ain't lost but $150. So that's when you develop that confidence. And again, pick people's brain and surround yourself with good people. And don't be afraid to learn. Like, get out there. YouTube, I got a couple of PhDs from YouTube University. All right. So make sure y'all download GroupMe. And that way we can kind of correspond, interact, talk about stocks, get a little bit more comfortable with the lingo and learn this thing. All right. All right. So this is the email. I need y'all to send me just 5 minutes after we get off the call. Send me 2 takeaways you got from the class today, good or bad. Right. And also 2 financial goals you wish to achieve from the stock market. Number 2, make sure you set up your mobile apps. That's your TD Ameritrade, Thinkorswim, and your GroupMe. The group name, y'all seen the group name? The group name is Take Profit Every Day. So once you download GroupMe, it's a public group. Right now it is public, but once we get it to a certain number, we will turn that group private. So I left it public so you can search it and find it and ask for an invite. Again, you must learn on your own to be successful. Like, you're not going to get everything you need from me. You're not going to get everything you need from one source. Just like stocks, just like the options contracts, there are many different variables that determine whether the stock goes up or the contract price goes up or down. There's many different variables that determines whether you're going to be successful or not. Like, you gotta learn different stuff. You gotta be intriguing. You gotta sit down and search YouTube. Go to different places. Go to TD Ameritrade. Once you download that TD Ameritrade, they got a whole education tab to where you can go through there and learn everything bit by bit outside of coming here and getting the information in your hands on, where you can ask questions and kind of converse with each other. And before, tell a friend, invite a friend. We're trying to build this platform to where we can promote financial literacy, tell people about things that not normally talked about. We didn't learn about this stuff in school. They should have taught us this in school. Like, I should have learned about this. My son is 23, I'm 43, and I'm just not learning about the stock market. Now, I just think if I had knew about it at 23, I'd probably be a lot better off today. Right? But better late than never. So tell a friend, invite a friend. We're here every Saturday. It's going to be the same link that I sent out to you guys. However you got here, feel free to share that link out. It's going to be 11 a.m. Central Standard Time, 12 Eastern Standard Time every Saturday. And to help somebody else, get here and get to this level and learn this good information, so we can get some good passive income where it doesn't take anything but clicking your screen just to make a few dollars. And again,
can you go back to the app slide real quick? Because I forgot the name of the apps again.
All right, we got TD Ameritrade, TD Ameritrade Mobile, then your Thinkorswim. Now, again, these two apps, they are the exact same thing. TD Ameritrade, Thinkorswim, they will have the same information. I just like to, this is how I like to do it. You don't necessarily have to do it. I got an iPad. I use my Thinkorswim to chart and look at the market. And then I use my TD Ameritrade on my phone to execute my trades. It's a lot easier to execute your trades. For me, it is on TD Ameritrade. And then Thinkorswim, I can kind of look at the charts and look at the different stocks and see how it's moving. But I do everything, all my trade execution, I do it from my phone. That's why I got my TD Ameritrade. And I have my Thinkorswim on both of them. I have them on my iPad and on my phone. But then I have my iPad set up, then I have my desktop, and I have my phone. That's how I am every morning at 9:30. All right, and GroupMe as well. Search the group. The group is Take Profit Every Day. And when you get in that GroupMe, make sure once you join the group, make sure you say hey or hi, because if you don't respond, it will kick you out. It's kind of like, so once you join the group, just, you can put a period, just put some type of comment in there so that it doesn't kick you out for inactivity. You just have to make one initial comment, and that way you're locked in. Okay. We went through that. Tell a friend, please invite somebody. I need everybody to invite somebody, help someone else get this information. I also have this recorded. I will upload this show onto YouTube, my YouTube channel. I will put it in the GroupMe so you guys can share that around as well. And you can go back and kind of review it on your own. So I will be uploading this to YouTube as well. Okay. All right, next class, we're going to go over some chart basics. Just kind of get you familiar with what's going on with how a chart looks and what's on it. Basic technical analysis and fundamental analysis. Technical analysis is just kind of like your RSI, MACD indicators. These are different indicators that determines which way the stock is going to move. We're going to do a little bit of your trade simulation. So you're very essential that you get your Thinkorswim downloaded so we can do some trade simulations on next class. We'll go into a depth on how to research a company. What are you looking for? What are some indicators of market movement and all that good stuff? And we'll dig in, of course, into a more option trading basics, as we're still, getting the fundamentals down and getting the foundation of you guys learning how to trade options. Okay. Anybody got any more questions, concerns, anything like that?
I'm good on my end.
Okay, great. Well, guys, get those emails to me. Y'all didn't get the email down. The email is right there at the top. takeprofiteverydayok@gmail.com. Need to get those emails to me. That's kind of holding you guys accountable. Let me know if you're serious about taking this option training to the next level. But I appreciate you guys. Didn't want to hold y'all too long. Good class. See you guys next Saturday. Don't forget to tell a friend, invite a friend, okay?
Thank you.
Y'all are very welcome. Y'all enjoy y'all weekend.
You too.